I'm here to introduce you to Serinus Energy. We are obviously an energy company. There we go. My name is Jeffrey Auld. I'm the president and CEO of Serinus. I have a 30-year background in oil and gas. I grew up in Canada to an oil and gas father, so I demonstrate a very low creativity with career selection. I entered the oil and gas business here in London. I was commercial manager new ventures for Premier Oil, some of you may know. And I then went into investment banking, and I was in the mergers and acquisitions group and the advisory group of Goldman Sachs for the bulk of my career. I left Goldman and I ran a company called Kazakhstan, which obviously produced gas and oil in Kazakhstan. It was New York Stock Exchange listed. And we sold that to the Chinese for $4.5 billion. Then I went back into banking. I ran Canaccord's oil and gas team here in London, and I ran Macquarie's oil and gas team. In 2013, I retired, and in 2016, I got a call from some of the major shareholders of Serinus asking me if I would step in and see if we could make this business a better business. So what is Serinus? As I said, we're an oil and gas company, principally gas. We produce about 74% of our production is gas. We produce gas in Romania and oil and associated gas in Tunisia. We're a low-cost producer. Everyone likes to say that. We produce our product for $8.68 a barrel of oil equivalent. So even back in April, when we all saw horrible commodity prices, we were cash flow positive. We've grown production considerably from about 300 barrels a day when I joined the business to about 2,500 barrels a day now. We have large acreage, big blocks, both in Tunisia and in Romania. And so there's lots of opportunity on these blocks. They're very underdeveloped, and we're essentially a development company. We have very strong cash flow. Like I said, with the low cost, low lifting costs, even with low commodity prices, we're able to generate good, strong cash flow. And in 2019, with about half the production we have right now, we produced $8.8 million of operating cash flow. So entering 2020, we'd almost doubled the production by the start of 2020, and we were looking at this year as being an exceptional year for us. And then the Saudis and the Russians started fighting at the same time. A pandemic broke out, and I think everyone saw the headlines where we saw WTI trading at negative prices, Brent trading at $8, and that affected us badly. So from a year where we looked at having a lot of free cash flow, a lot of operating cash flow, we turned into a year where we were we cut our operating cash flow considerably. We owed debt to the European Bank for Reconstruction and Development. We owed $33.7 million of debt, and we had a debt payment in June of $8.8 million that we couldn't make. So we renegotiated the debt, and just this morning our shareholders approved recapitalization of the business where we paid back all of our debt, paid off all of our debt. And so we emerged from our recapitalization as a company with good, strong cash flow, even at low commodity prices, production that has grown considerably and will continue to grow, and lots of opportunity, lots of near field opportunities on our existing assets. We do a reserve report every year, so we don't just do a CPR when we do a transaction. We do a reserve report every year. Our 2019 reserve report, independent reserve engineers gave us 10.58 million barrels of 2P reserves. That means we're trading at about 2 pounds a barrel right now. We work in areas that have strong fiscal terms. So alongside that lifting cost, we have low fiscal costs, and we also have a very low G&A. And our business is resilient to COVID, helped by the fact that some of our fields are out in the middle of the Sahara Desert, but we work in remote places, so we're able to seal off our operations, and we've had no interruptions from COVID. So in Romania, that bottom cartoon you can see, we have a 3,000 square kilometer block in northern Romania. We have 100% of the license, and we found, developed, and put on stream what we call the Satu Mare gas plant. This is a gas plant that has a capacity of 15 million standard cubic feet a day. That was a project that was a cornfield when I joined. and we've built that into a major producing asset for us. On that block, we estimate that there's 181 million barrels of oil of unrisked prospective resource. 73 million barrels risked, so there is lots of activity that we can get involved with immediately surrounding our existing field. In Tunisia, we have 5 concessions. The biggest one is right in the middle of the country, just south of that big salt lake. It's called the Sabria field. The Sabria field is a 358 million barrel oil in place. Again, not our numbers, that's an independent reserve engineer's numbers. 358 million barrel oil field, of which 1.2% has been produced. So very, very low development work has happened on this field for a variety of reasons. Simple things like this is one of the few oil fields I've seen in my life that doesn't have any pumps on it. So simply putting pumps on oil fields are things that we've been able to do to dramatically increase the production. But the essential fact of that field is there's 358 million barrels in place, of which we should be able to get to a recovery factor of 25–35%, and we're currently at 1.2%. In the south, we have the Schwesh fields and the Schwesh Asida fields. These fields are existing producing oil fields. The fields need workovers, the fields needs development work. So we're not talking about being an exploration company, we're talking about the oil already being there and us doing things to extract that oil better and cheaper. I think I've heard every presenter tonight talk about the COVID effect. The COVID effect has been pretty dramatic for resource companies. You can see our production, the steep growth in production. That's primarily by putting fields in Tunisia back on stream and by putting the Muftino gas plant on stream in Romania. You can see the revenue drop. These are third quarter, we're quarterly reporters, so our third quarter financials came out a couple of weeks ago. Revenue drops significantly. That is wholly to do with price. So we've managed to increase the production, but the price still has affected us badly. But what you can see from cash flow from operations is we've been cash flow positive, and we are cash flow positive even when you have the commodities disruptions that we've had this year. And our operating netback, again, simply the effects of commodity price. So what you have is, since 2019, 394, almost 400% growth in the production, 70% higher than the third quarter in 2019, with a revenue growth since 2018 of 278%, strong growth in all the metrics, disappointing commodity prices. But as we come back, remember that $8.96 lifting cost. Every dollar that we go up, we're at 50 now. These are good, strong prices for us, and they're very, very positive for our revenue and our cash flow. So the investment case. The current share price obviously shows the depression with the effect of having to pay back our debt, and that happened this morning. The COVID and the Saudi-Russian commodity dispute. But what we've done is we've lowered those costs, we've kept those costs down, we've now eliminated the debt, so we have no debt going forward into 2021. That effectively is transferring enterprise value, 33.7 million of debt transferred to equity value. What I didn't say about the debt transaction is we negotiated a 50 cents on the dollar equitization of that debt. So new equity paid $16.5 million to retire $33.7 million. That's a transfer of enterprise value from the debt side to the equity side at half price. That gives us a very resilient balance sheet now. This balance sheet, since I joined, the debt was put in place in 2013. The day the debt was put in place, oil was trading at $108 a barrel. So obviously the debt has been a burden on the company. The company was over leveraged by the previous management, and that's now been resolved. So now we can let these projects demonstrate how good they are. We can let that cash flow come through the company, the shareholders, and the opportunities that we have. So going forward, we want to take that cash flow and we want to invest in these projects. These projects are high return projects, and I can show you in a future slide just exactly what those returns are. But things like putting pumps into an oil field, obviously they're high return because you're increasing the production. It goes straight through an existing facility, so there's no capital for the facility. You're reaping revenue and cash flow right off of that. So your capital investment has a very, very high return because you don't have to invest in surface facilities. And we have many, many opportunities to do this, not just pumps in Tunisia, but we have an existing gas plant now in Romania, so we can run future fields through that gas plant. low cost and high return projects. I think it's very, very clear the return on some of these projects. If you look on that table, we are currently getting ready to drill a well in January. It's called the Moftino 1008 well. It is a producing well on the Moftino gas field. It will cost us $3.2 million. That's fully completed and tied back to the gas plant. It will increase the production by about 5 million standard cubic feet a day. All our previous wells have flowed about 6 million standard cubic feet a day. We'll be conservative here. That will give us $10.2 million of NPV at 15%, or an IRR of 140%. So very, very high returns, 140% IRR, simply because you're running it through an existing facility. Artificial lift, so wells on an oil field in Serena in Tunisia. For four wells to put 4 pumps in, it's $9.3 million. But it increases the production by almost 4,000 barrels a day, $48.5 million of NPV, and 132% IRR. Overall, the projects that we can demonstrate in the next 18 months on our existing fields, adjacent to what we're already doing, development projects that don't require exploration work, can increase production by 5,670 barrels a day. We're currently producing 2,500 barrels a day. So a very, very significant increase in production. And the cost of that production is $1.34. So Russian and Saudi type development costs. It's because our wells in Romania are shallow and they go existing plants and putting pumps in. So very low risk. Oil companies always have risk, but the risk of these is not exploration risk. The risks of these are mechanical development risks. So high return projects with cash flow comes immediately to the company. As I said, we are a quarterly reporter. We will remain a quarterly reporter. This is an extract from our third quarter report that just came out a couple of weeks ago. You can see again the strong cash flow, the cash flow increasing over the period. You can see that we paid back $2 million to the EBRD. We weren't able to make the $8 million payment, which catalyzed our ability to bid them for the debt at half price. But we were able to pay $2 million. So we are one of the few oil companies, small oil companies, that managed to pay down debt in the middle of a pandemic. And that's a testament to the strong cash flow that we have coming out of the business. And then down at the bottom, these are our accounts. These are there we have the $8.96 lifting cost. We've managed to reduce that from $13.78. We're probably at the level we can reduce it to. There's not much more we could do. But that's a very, very strong number for us, and it's a number we're very proud of because it gives us resilience through the commodity cycle. So at $8.98 or $8.96 lifting costs, when you're at $35, really does make a big difference when you're at $65 a barrel. So I promise to be quick because I'm the last one tonight, and I know everyone wants to get going. In summary, what do we have here? We've got a good, strong cash flowing business. This isn't a business that needs to come back to shareholders again and again and again to do its projects. We just went to our shareholders to pay down debt, and we did that at 50 cents on the dollar, and we felt that that was a good proposition for our shareholders to be able to free up the cash generation that we have in the underlying assets. We produce from good, strong fields that can continue to grow that production. And again, I come back to the low cost. The organic growth profile, all around us, we have big blocks. So like I said, in Romania, 3,000 square kilometers. It takes 2 hours to drive east-west and 4 hours to drive north-south. There are a lot of things we can do on these by just simply stepping out from our existing producing fields. And stepping out reduces the risk. The recent placing that I talked about, our shareholder meeting this morning approved that placing. It immediately unlocks the value of transferring that enterprise value to the equity side. So $33.7 million of debt at half price gets transferred to the equity side of the capital structure. And we have this strong future work program where almost 6,000 barrels a day of oil equivalent can be added to the business at super low cost. And that just comes straight through to our cash flow and our earnings. And so to be quick, I will end it there, and I will ask if anyone has any questions. Happy to.
Well, it's a question from me, if you don't mind me asking. I don't want to kind of put the boot into previous management, but the work program you've described and increasing the production seems like an extraordinarily common sense thing to do. Why wasn't that being done before?
I think there was too much other exciting things to do. There was lots of exploration wells being drilled, and instead of allocating the capital to generate cash flow and then step out and do the exploration, I think it just the sequence got lost. So you know, I'm not here to criticize previous management. I'm here to build a business and to make sure this business runs as efficiently as possible. But I've always believed in whatever business I've been running, revenue becomes before expenses. You have to build the revenue and then you take the expenses on. So previously there were lots of business units. We've slimmed this down to our two best, Romania and Tunisia. And we've slimmed this down to doing things where we can generate the cash flow. I'm an ex-Goldman Sachs banker. I'm in the business of making money. I'm not really in the business of putting money down the hole on some wild gamble. I'll do that if I think that there is a really, really good return and we can understand the gamble. But right now, we don't have to do that. We can just go out and like I say, when I found out there was no pumps on the field, you know, I don't think I've ever seen. I mean, every TV show you ever watched that has an oil field in it has a pump on it. So yeah, it is very common sense, but it's also what the conclusions you come to when you start allocating your capital for a return instead of allocating your capital for sort of geologic knowledge.
Okay. Questions from the audience. How do you see the new Russian gas pipeline into Europe affecting your business?
Well, there's a few pipelines coming into Europe. I mean, the Russian one is Nord Stream. So I think really we're a gas producer in Romania. Romania is a little bit isolated from the European gas market simply because the pressures in the pipelines in Romania are lower than the European pipelines. So they can't actually export right now. So we have a bit of a captive market, and you can see that in the prices we get. At the start of 2020, we were getting $7.58 a thousand standard cubic feet, whereas Central Europe was getting $4. So there is a very different price dynamic. Now, clearly, going forward into the future, more gas in Europe and cheaper gas in Europe and opening of the pipelines between Romania and Central Europe will homogenize that price. So over time, we will start to trade towards less an isolated Romanian gas price and more a Central European gas price. But remember, we still have very, very low lifting costs. So being onshore, being an onshore gas producer means that we can compete with current Central European gas prices and make good money at current prices. We just have a little bit of a benefit for the next 3 or 4 years while Romania stays a little bit isolated. The other point I'd make is the marginal gas supply into Central Europe, Western Europe, is not coming from Russia or Algeria. It's basically Atlantic Basin LNG. And so we look far more closely at the cost stack of Henry Hub through the Atlantic Basin LNG cost stack than we do at the Russian gas to sort of give us an idea of where European gas is going. But for right now, I think we're nicely isolated, and we will be for the next 3 or 4 years.
Okay, I have a couple of questions asking just for the clarity on the debt and the situation you described earlier. Is all the debt now paid down, or is anything still owing, or is that all taken care of?
So you catch us at a bit of a unique time because we had our shareholder meeting this morning to approve a placing that raised the money to pay down the debt, and that's completely paid down the debt. So we raised enough to pay $16.5 million to the EBRD, and for that they retired the entirety of the $33.7 million. So essentially a half price sale on the debt. They also, because they believe in the growth of the business, asked for 9.9% of the enlarged share capital. So the EBRD will be a 9.9% shareholder. They are a 9.9% shareholder as of this week. So yes, the debt is gone. We are a debt-free company, no debt on the balance sheet at all, and a new 9.9% holder in the form of our former bank.
And what's the current net cash position?
We've got about $2.5 million of cash.
And a question here: did any institutions come in on that recent placing?
All institutions, 28 institutions, some high net worth individuals, There was some private wealth managers invested in it. There was some family offices, but the bulk of it was institutional.
And to accelerate the work program or the production development program, do you want to try and do all that yourself, or do you think you're going to bring in partners, JVs, or any other parties?
Yeah, look, philosophically, we're not a business that wants to have 100% of any asset. If there's a partner that looks to add value for us and wants to carry work that we think is valuable, then everything is always up for sale. I was once rudely quoted by saying that my grandmother was up for sale. It was just a question of the price. Of course, we look at having partners. Our partners, we would look for partners that very much added something other than just capital, because we look at the cash flow we can come out of next year with. We've got plenty of cash flow to do the core projects that we want to do right now. So we're a small company. We can't get all the projects done that we want to get done. So if someone comes in, it's not just a question of capital, it's what they can add. But philosophically, we're not a company that demands to have 100% of our assets. We do believe, and we have shown, that we're quite a good operator. We manage costs very well. We execute quite well. So we would look to continue to be the operator of the assets if we did have partners. The partners are always on the, it's always something you look at.
Okay. Question here: where do you see the firm in 3 years' time?
Well, that work program I laid out for you is an 18-month to 2-year work program. So if we can execute on that work program and add the 5,000-6,000 barrels a day, that would take us to a 7,000 or 8,000 barrel a day producer. So at that point, we would really, the cash flow that we would be generating would exceed the capabilities of the company to allocate the cash flow. So we would need to grow. We would need to grow into other business units, or we would need to distribute. That's simply the arithmetic. Now, I'm not in the business of creating empires. I had my empire building phase of my career. We are in the business of allocating capital, and if the best capital allocation is a distribution back to our shareholders, then obviously we'll pursue that. But if we were able to in the next 3 years become an 8,000, 10,000 barrel a day producer, we would have to look at increasing the assets to be able to allocate to more assets, simply because of the volume of cash flow.
Okay. Jeffrey, I think we're done there, actually. That's been really, really great. Thank you very much for joining us and presenting this evening and telling the story. I've really enjoyed that one. Thank you.
Thanks very much for having me.